basic principles. First of all, if you think about group health insurance, one of the first things you have to remember is you cannot get a group of people together just because you want to take out insurance. Say, hey, we're a group, now we're going to get group insurance. Can't do it. It's against the law. There is something called a master policy when you take out a group health policy. The policy is actually between usually the employer or whatever group, is sponsoring the people and the insurance company, and there's that master policy. And then each individual who is covered in that group gets what is called a certificate of insurance. It's usually a one-page document, kind of recaps. It says who's the insured, what's the amount of benefit, if there's beneficiaries, the date of the coverage, things like that. It's just a one-page kind of synopsis of what the coverage is for the person. It follows group underwriting rules. Group is always going to have a lower premium cost than individual coverage because they can spread the risk out over that larger group of people, that law of large numbers. They like that a lot. There's two different ways that people can contribute in a plan like this. There's a contributory plan and there is a non-contributory. Non-contributory, for example, means that the employer is going to cover 100% of all of the employees. That is called non-contributory, and 100% have to be covered. Now, if the employees are going to share in the cost of premium, then it's called a contributory plan. And with a contributory plan, at least 75% of all eligible employees have to take the coverage. What do they mean by eligible? Easiest one to remember, usually one of the biggest dividing factors on who can be covered and not is, are you a full-time employee instead of a part-time employee? A lot of times part-timers are not offered this kind of benefit. So for eligible, you would have to, for example, be a full-time employee. And then if so, 75% of those employees must take the plan, and you're going to share in the premium costs. What are the types of eligible groups who could take advantage? Employer-sponsored plans, like we think of as benefits at work, is probably the biggest group or the largest types of plans out there. Very, very popular. They're a wonderful benefit for employees. And a lot of times employers will offer these plans as a way of retaining good people in the business. Then you have something called a MET, which is a multiple employer trust, or an MEWA, a similar type of group. These kinds of groups, they're trusts that are formed to get insurance, to acquire insurance. But the thing to remember, on a MET, for example, they have to be in the same industry. For example, maybe you've got a couple of 3 or 4 or 5 small little printing companies, and they form a MET in order to get benefits for all the people in those particular companies that join together. So they have to be in the same line of business. So remember that. And then you also can sometimes get group benefits through creditor groups as well. Group health insurance. Underwriting. Let's take a look at underwriting for a while. First of all, what is the purpose of the group? They have to have another reason to exist other than just being a group who got together because they wanted to try to get insurance benefits. Remember, they cannot form a group solely for the purpose of trying to get coverage. The size of the group, usually you have to maintain certain participation levels in order to keep the group coverage. So that's something that has to be monitored every year typically. Also, they want to watch the flow or the turnover of the group, the new employees who come in maybe and who are maybe younger and maybe more healthy than some of the older employees. So you want to always make sure that there's a good balance if you can. They must be non-discriminatory, meaning automatic determination of benefits. Everybody gets the same benefits. Just because I maybe have a history of some health issues, if I'm in the group, it doesn't make any difference, because the theory is there's going to be enough people who are maybe younger or at least healthier than I am, and the healthy kind of offsets some of the few that might have some minor or even major health concerns. That all kind of evens it out. The premium determination has a lot to do typically with any insurance. Your age and gender, very important. Your occupation of the entire group is going to be considered a factor as well, because some occupations are more dangerous than others, which could cause a higher premium, right? And then there are the certificates of insurance. This insurance is guaranteed. It is not individual underwriting. They underwrite the entire group, so you can have some people who are very ill and have some people who are very healthy, and you're going to get that nice kind of middle of the road premium. It's going to be always a lower premium than if you tried to get insurance coverage individually. Coordination of benefits provision. This is usually only found on group health plans. The purpose is to avoid duplication of benefits when an insured might be covered by more than one policy. It enforces the principle of indemnity, meaning you can't make money by filing multiple claims. Okay, so you have a loss that occurs and you, the insured, submit a claim to the insurance company. One of your insurance companies, let's say you're covered by a couple plans, one of them is going to be considered your primary coverage. That's going to provide the full benefits as specified by your policy. Then if you have another policy, that's going to be referred to as the secondary policy or the secondary coverage that you have. Anything that the main policy didn't cover, then you'd go to that secondary policy to pick up any of those things that might not have been covered. And there might also be some different benefits that might be payable under that secondary policy. But overall, you're never going to be made more than whole, or you would be going against the principle of indemnity. The total amount paid cannot be more than costs incurred or total benefits available under all of the plans together. Again, principle of indemnity. Continuation of health coverage. Let's talk about COBRA. There's a few misconceptions about COBRA. People always say it's very, very expensive. In actuality, it's not, and let me explain that to you. First of all, COBRA is the continuation of your group health coverage. Even though you've left the company, they still keep you in the group as if you're still there as an employee. It's just that you're not, but you're going to keep your benefits. The employee can apply within 60 days of termination to take advantage of the COBRA benefits. The coverage is usually good for 18 months, but it could be up to 36 months for dependents after an employee's death or divorce. So they extend the period of coverage longer in those specific circumstances. The employee actually pays 102% of the premium. That's all. That's more, just that 2%. But remember, the reason why people think that it's a much more costly item is you're used to seeing only what you as the employee paid on the premium. Don't forget the employer generally is paying a higher premium amount on your behalf. So you're actually paying the premium you were paying on your own. You are also paying what the employer was paying to cover you. So that's why it seems so costly. But they only charge you about a 2% kind of a fee in order to keep you in the plan, even though you are not an employee. So that's the true way that COBRA works. You still have all the benefits of that plan if you choose to use all those benefits. Now, there are some disqualifying events. If, of course, you don't pay the premium, you're going to lose the coverage, just like any insurance. If you have coverage under another group plan, then you don't need to invoke the COBRA benefits. If you're eligible for Medicare, you would not use COBRA in that case. If the employer terminates all group health plans, there's nothing left anymore, then of course you would lose the coverage with everybody else. There's no plans to take advantage of. And then also, if you are terminated for misconduct, COBRA benefits would not be offered to you. This is only for people who are terminated without cause. Medicare has some eligibility requirements. Basically, it's for anybody age 65 or older, or if you have end-stage renal disease, sometimes referred to as kidney disease, then it's any age. They remove the age 65 portion. Or if you are a person receiving Social Security disability benefits for 2 years, you would be eligible for Medicare. Don't confuse Medicare and Medicaid. Medicaid is a welfare program. Medicare is health benefits. It's got parts, not plans, but parts. Part A covers hospital insurance and other things that go along with a hospital stay. Part B is your medical insurance. Think of your doctor bills, things like that. Part C is actually called Medicare Advantage. It is a fully functioning HMO. Depending upon where you live geographically, you might be able to participate in an HMO program that accepts Medicare clients or customers. And so you would not have Part A or Part B, because if you take Part C, it's all-inclusive. It's a fully functioning HMO. Usually it's in the larger metropolitan areas, just to kind of give you an idea of the geography that goes along with that. And then Part D is easy to remember. That's the prescription drug coverage. That's one of the newer parts of Medicare. Let's talk about Medicare Part A and Part B. Enrollment periods for these. The initial enrollment period is typically 3 months before you reach age 65 or 3 months after you turn 65. So you want to be aware of those. The general enrollment period then would be January 1st through March 31st every year. So you could join kind of in the beginning of the year. There are some special enrollment periods. For example, anytime an individual who's still covered by an employer through active employment, or during the 8 months following, if your employer should terminate your health plan at work, or if you are an individual who is disabled and working. Those would all be special enrollment events for someone. Medicare Supplement policies, or Medigap policies. These policies are offered by insurance companies, and it's to fill the gaps of things that Medicare doesn't cover, because Medicare doesn't cover everything. So they are issued by private insurance companies. To be eligible, you have to have Part A and Part B of Medicare, because then you buy these policies to fill the gaps that your A and B aren't covered under. You cannot duplicate Medicare benefits. They are guaranteed renewable. They're a senior product. A lot of senior products are guaranteed renewable. You have a 30-day free look. Again, typically on any senior product, you're always going to have a longer free look period, meaning a time for you to decide, okay, maybe you signed that application, wrote the check, but you've got time to think about it a little bit. Senior products, again, usually get a longer time frame to make sure that they're comfortable and that they're understanding what they're buying. It's a 30-day free look. And the core benefits, which is Plan A, has to be offered in all of the plans. Medicare Supplement plans. Think of that word, supplement. It'll help you remember what these plans do. Medicare Supplement plans fill in the gaps or supplement the coverage that you have with regular Medicare. They are plans, and they're A, B, C, D going up the alphabet. They are not parts. Parts are Medicare, so read the words carefully while you're studying. Every one of these Medicare Supplement plans has to have Plan A, all the core benefits that are in Plan A. Every plan has to offer at least that. Also interesting with these plans, it doesn't make any difference which insurance company provides, say, for example, Plan D. They're all the same. Every insurance company's Plan D is the same as everybody else's Plan D or Plan G or K, any of the plans. They're structured that way to help keep the confusion down, because these are considered to be senior citizen products, and they want to try to keep it as less stressful and more reasonable to understand by being consistent across the board. So those core benefits are going to be in everything Plan A all the way through N. Skilled nursing coinsurance, the only two that don't cover that, for example, are plans A and B. Those are the lower end plans. The other ones do. Sometimes they have a specified percentage of what they'll pay. Part A deductibles Plan A does not have a Part A deductible, the deductibles that you have to meet on your Part A of Medicare, but most of the others do. Some of them have listed percentages, for example. Same thing with the Part B deductible. Plan A and B do not cover, but everything, item C and item F, Plan C and F, do cover the deductibles for your Part B of Medicare, those gaps that would happen. Part B excess, 100%. There's only two policies that cover that, and that's F and G. And then if you look at another column here that we give you, it's foreign travel emergency. Very important. If you've got some healthy, lively senior citizens who travel, many of them will travel abroad. And if they're covered by these policies, you're going to want to make sure that they utilize a policy that would cover them should they become sick or injured or whatever in a foreign country. Very important to remember. Let's talk about the levels of care. These have a lot to do with terminology. Let's kind of go through some of these. Skilled care means nursing and rehabilitative care by medical personnel. You have intermediate care. That's occasional nursing or rehabilitative care by skilled medical personnel. Then you have something called custodial care. It's assistance with personal needs, those activities of daily living. Non-medical personnel can take part in this, institutional setting or in the home. Home health care, they actually bring the health care to the person in their home, the skilled nursing services. Adult daycare. Might not realize that there is adult daycare for persons who need to have some care during the day, maybe to give their caregivers a break during the day so they can maybe continue their jobs or whatever. Usually it's in like a community center type setting. They get meals, they have activities, their medications will be given to them, things like that. And then there's respite care for relief of the family caregiver. If you are a caregiver of someone suffering from Alzheimer's and they are living with you in your home, it's a 24-hour round-the-clock job that you have. And it can be very debilitating to you and wear you down, especially if you're trying to continue your work and things like that. So if the policy has respite care on it, that loved one who is caring for this person, this person who has Alzheimer's, for example, they can make arrangements at a nursing home for a weekend stay. Take your loved one there Friday night, pick them up, say, Sunday afternoon, and you've got, 48 hours or so where you give up your responsibilities and have a little bit of a break to kind of recharge and refresh yourself, and then go and bring your loved one back home into the environment where they are the most comfortable. Respite care is a great feature. Part of Social Security benefits is something called Social Security disability benefits. A couple of features you need to be aware of. First, let's talk about eligibility. You have to have accrued 40 work credits or 40 quarters of work where you're actually paying into Social Security. Just so you know, 40 quarters means 10 years of paying into Social Security. There are some eligibility exceptions that apply here as well. If you go through and you've got your 40 quarters and you get approved, you go through the approval process, it can be kind of lengthy. After you're approved, then you still have to wait another 5 months. It's a waiting period of 5 months. Then at the end of the 5 months, the benefits would start to pay based on what is called the PIA, which is the primary insurance amount that would be paid through this Social Security disability benefit. When do the benefits cease? They cease when retirement benefits start, or when the disability ends, or, of course, upon death. The general powers and duties of a state insurance department. What exactly do they do? They are there, that department is there, to control and supervise insurance business in the state The head of the insurance department is there to enforce the state laws, the state statutes that relate to insurance. This department issues licenses and certificates of authority. That's where your insurance license is going to come from, and that's where your insurance company's certificate of authority is given. They approve all the policy forms that every company is going to use in the state because they want to make sure the language is clear. They conduct examinations, investigations, and hearings if someone files complaints or has issues with either agents or insurance companies. They can impose penalties. Now, they can't force you to court. If they think it's a bad enough situation, they will have to go through the state's attorney general in order for them to press those kinds of charges. Do remember the Department of Insurance does not set premium rates. Who does? The insurance companies. And they try to keep the rates very competitive usually in the market. And they do not establish fines and penalties. Those are going to be clearly defined in the state statutes. Examination of insurers, insurance companies. How often are they required? They can be examined anytime if there are sufficient complaints, but usually it's every couple of years. These examinations apply to all authorized insurers, meaning all companies who have those certificates of authority in the state, and insurers pay for that examination. So, types of insurance licenses. First of all, let's look at the producer. Unfair trade practices. Misrepresentation, you hear that a lot. It is false, misleading, or deceptive statements about policy terms or benefits. Making a material misrepresentation is against the law. Material meaning important. False advertising. A lot of this is common sense. Do you really think that you could put anything in an advertising that isn't completely true? No, you must always be sure that you are truthful and not deceptive or misleading in any advertising that you do. Rebating. Rebating is offering benefits or services that aren't exactly specified in the policy. If you were to give somebody something extra that isn't spelled out in the policy, that's rebating. It's against the law. Twisting is a term that is used. It's misleading comparisons of policies because you're trying to get somebody to buy your policy, not because it's better for them necessarily, but because you need the commission. That is twisting. It is illegal. Defamation is making malicious or false statements against a company or a person, again, usually to undermine them and try to get the client to not use that particular agent or company. And then unfair discrimination, you just simply cannot do it. You're discriminating on rates, premiums, or benefits just because of a person's marital status or ethnicity or things like that. It cannot be done. It is against the law. Commissions and compensation. It's really very simple. If you're going to be in the insurance industry, you must be licensed in order to receive any type of compensation, which typically is commissions. You have to be properly licensed at the time of the transaction. Violations and penalties. Let's talk about violations first. An insurer or agent is suspected of committing a violation involving an unfair trade practice, like rebating, for example. The head of the Department of Insurance is notified, typically by the client, and they may issue a statement of the charges that are going to be brought against you as the agent. Then, hearings can sometimes be called. An aggrieved party may contest and require a hearing. You always have to have advanced notice of when the hearing is going to take place. Hearings are held fairly quickly. They don't let it drag out too long. And the aggrieved party has a chance to be heard. Now, a desist order, It's issued by the Department of Insurance, usually the head of the Department of Insurance, and it may be issued before a hearing, because if they feel that you're doing something that is such a danger to the public, they will issue a cease and desist order before the hearing to get you to stop immediately in order to protect the public. And then other penalties that could happen, they're going to be established within state guidelines or state statutes. They're imposed based upon whatever happens in the hearing, what the outcome of the hearing is. You could have your license denied if you were in the process of maybe getting a license. You could have it suspended, which suspensions usually go anywhere from a short period of time up to a year, or you could have it revoked. Revocation oftentimes is permanent, and there could be monetary fines as well. Insurance Guarantee Association. First of all, this is a nonprofit legal entity. It protects the insureds from insolvent insurance companies. It's funded by the member insurers, which basically the members are all insurance companies who are admitted to do business in the state. They all pay into this fund. They pay in based on usually the face amount of coverages that they carry in that particular state. Then what happens, should an insurance company become insolvent, the receiver who would be watching over that company until the insolvency can go through would be using those funds from the guarantee fund to pay claims and things like that in order to protect the insureds of that insolvent insurance company. Remember, it is illegal to advertise this protection of the association when you're selling. You may not use this association as a selling point when you're talking to clients. The general powers and duties of a state insurance department. What exactly do they do? They are there, that department is there to control and supervise insurance business in the state. The head of the insurance department is there to enforce the state laws, the state statutes that relate to insurance. This department issues licenses and certificates of authority. That's where your insurance license is going to come from, and that's where your insurance company's certificate of authority is given. They approve all the policy forms that every company is going to use in the state because they want to make sure the language is clear. They conduct examinations, investigations, and hearings if someone files complaints or has issues with either agents or insurance companies. They can impose penalties. Now, they can't force you to court. If they think it's a bad enough situation, they will have to go through the state's attorney general in order for them to press those kinds of charges. Do remember, the Department of Insurance does not set premium rates. Who does? The insurance companies. And they try to keep the rates very competitive, usually, in the market. And they do not establish fines and penalties. Those are going to be clearly defined in the state statutes. Examination of insurers, insurance companies. How often are they required? They can be examined anytime if there are sufficient complaints, but usually it's every couple of years. These examinations apply to all authorized insurers, meaning all companies who have those certificates of authority in the state, and insurers pay for that examination. So they are very serious and not to be taken lightly. Types of insurance licenses. First of all, let's look at the producer or agent license. Remember, you as an agent, you represent the insurance company, not the client. You have to be appointed to transact business on behalf of the insurance company. So you have to have your insurance license in the state, and then every insurance company that you're going to represent, you must be appointed with that insurance company So basically, the insurance company knows who's selling their products in a particular state. Then there's the business entity, the agency, for example. It's a corporation, an association, or a partnership. And you have to have someone who is listed as the designated agent of that business entity. Then there's non-resident license. You get a resident license in your permanent state of residence, and then you can get non-resident license in as many other states as you need. Would you do all of them? No, absolutely not. But if you have clients living in other states, then you would need to get a license where your clients reside. You can also get a temporary license. They're usually issued for the continuation of existing business. They're for a short period of time. They are approved by the Department of Insurance, and they're not typically not renewable. What these sometimes will happen, you as an agent, maybe you have some outstanding commissions and you unexpectedly pass away, and your spouse would be most helped if he or she could get those outstanding commissions. So they could apply for a temporary short-term license in order to receive those outstanding commissions, because you must have a license in order to receive an insurance commission. You can never get commission if you're not properly licensed. Agent licensing. You have to be at least 18 years old. You have to take and pass the state's licensing exam. You have to then apply to the state and pay whatever fees are required. And you must be of good character, because you are going to be put into a position of trust with your clients, and they want to make sure that you're not going to abuse that trust. So once you get a license, you're not done. You have to do some things to keep it in good order. You have to do continuing education within certain licensing periods. It's going to vary state to state. You have to pay renewal fees when you go to renew that license. You have to always keep your name, current name, especially if you marry or remarry, your current address. You always have to make the state aware of any of those changes. And you also have to be aware of any reinstatement rules that might apply. Continuing education requirements. How many hours of continuing education must you do? Be aware it's going to be different state by state. You can always find it in the state statutes. You want to make sure you are always aware of the hours of continuing education and the time frame in which to get them done. Are there ethics requirements? Again, it's going to vary by state. Make sure you're aware. Oftentimes there's an ethics requirement that has to be made, and it's part of the total number of CE hours that you must do. And how long is a licensing period? Again, it's going to vary from state to state. It could be 2 years, could be more, could be less. Always be aware it's your responsibility to know these details in order to keep your license in good order. Unfair trade practices. Misrepresentation, you hear that a lot. It is false, misleading, or deceptive statements about policy terms or benefits.